Hello, it's great to have you here with me today or this evening, depending on what time you're watching this. But my name is Stephen Perillo, and I will be your financial educator for the next half hour. I'd like to welcome you to the How Money Works Elements educational series taught right now on Zoom. The course is based on our groundbreaking book, How Money Works, Stop Being a Sucker, which is now there's been over 500,000 copies in print. And so How Money Works is the first financial education book that anyone at any age can enjoy and benefit from, age 10 all the way to age 100. And speaking of the number 100, the book has now been featured on over 100 prominent TV shows, including CNBC, CBS, ABC, and Fox. The How Money Works book has received a rare endorsement from the Heartland Institute of Financial Education. And it's been reviewed and referenced all over the web, including the popular online financial publication, Make It by CNBC. And you can also follow How Money Works on Instagram for practical tips and helpful resources. And if you haven't received a copy of this book yet, just let me know when you finish watching this presentation, and I will be happy to make sure that you get a copy. And so our class today is actually the third of the 5 elements, and it's titled Protection. Once you complete all 5 elements, you'll actually earn a certificate of completion signed by the authors of this book and me also. And so students who attend at least one of the elements classes can take advantage of a free 30-minute consultation with one of our How Money Works experts that are trained to help you chart a course to financial independence using what we call our 7 money milestone methodology. And so your income creates wealth. This is why the second of the 7 money milestones after boosting up your financial education should be to protect your income. So let's get started. We're starting this class with proper protection, milestone number 2, for a very important reason. You need to protect yourself and your family from a possible future loss of income or savings before you chart the rest of this journey. And if you were to die prematurely, your family could be left without your income in addition to being without you. Your current savings might not be enough to take care of them. Though protecting yourself is more important than protecting your property, as Thomas Paine put it, you might not be able to fully protect yourself from illness and accidents, but you can protect your income and your wealth. Ironically, protection of your financial assets is called life insurance. It's a defensive strategy motivated by a sense of love, responsibility, or both. How much life insurance should you have? The answer is that it's different for everyone based on your situation. However, as a rule of thumb, we actually recommend you consider having life insurance coverage that's at least 10 times your annual family income. As an example, if you earn $50,000 a year, you should consider $500,000 in coverage. At a conservative 5% rate of return, that money invested would replace half of your income. For a more specific calculations of your family's need, we could sit down and have a deeper conversation about that. Together, you can consider factors like how old are you? How much debt do you have? Your current health, the number of dependents, your role in your business, and your overall financial situation. Many people, like Dana here, didn't know 10 times your income was just the starting point for protecting your income. Sounds expensive, but you need to look closer into it because before you decide you can't do it, you may be pleasantly surprised. The same people who underestimate how much life insurance they need have a tendency to overestimate how much it will cost. Both assumptions can keep families from putting proper protection in place. And as Insure.com says, only 59% of Americans have life insurance, and about half of those are actually underinsured. You and your financial professional should cover your short-term and long-term debts and other outstanding loans, your financial goals, your mortgage or your rent payments, how old your children are, and how much their education could cost. Just like so many other things, life insurance with all the options out there seems complex at first. But once you know a little, it becomes far more simpler. To start, it's important to understand that all life insurance usually falls into two basic categories, which are temporary and permanent. So let's look at term life insurance, which provides coverage for a specified period of time, like 10, 20, or 30 years. It's the most affordable life insurance available because it provides one core feature, which is a death benefit, the money paid to the beneficiary when the insured dies, and because it expires after that term. With term life insurance, it's possible to have financial protection for your family or business with a relatively small monthly payment. This can make it a fit for anyone with a limited budget during times of highest financial responsibility, like raising your children, paying off things like your mortgage or college, or running a company if you're a business owner. But what happens when the term on your insurance ends? There are two scenarios you can look at. Scenario one is that if you don't need coverage anymore, you can simply just let the policy end. No fuss, no muss. But what if after your term, you still need coverage because you're still paying off your home or you're a single income couple? Or maybe you're supporting grown children or grandchildren, or you're still running your company. For these reasons and others, you might actually want to consider scenario two, which would be keeping the term insurance. If you're in good health or your term policy has guaranteed insurability, you might be able to renew your old policy. Remember, if you want a completely new term policy, you have to qualify medically again. If you can't qualify, a new term policy might not be an option for you. If you do qualify, the new policy will cost more because of your age. The older you are, the more expensive new term life insurance will be. So this is what we call the financial X-wave. In your younger years, represented in the blue on the left, you typically have more responsibility and less accumulated wealth. In your later years, the yellow side, the plan is for your accumulated wealth to increase as your responsibilities hopefully decrease. Term insurance is typically most useful when your responsibilities are higher and your wealth is lower. The left side, which is on the left side there, if these two factors flip later in life as planned, term insurance becomes less practical. And again, your financial professional can help you take a look at that at the X wave and see how it could be applied to your specific situation. Now, so let's look at permanent life insurance. Like term, it provides a death benefit to protect your family financially. However, permanent insurance is designed to be kept and protect you for your entire life, not just for a period of time like a term policy. Think of permanent life insurance as a lifelong strategy that can protect your family today, secure your wealth in the future, and provide for your family after you're gone. There are three important benefits of permanent life insurance. Number one is life insurance protection for your entire life. Two, with many permanent life policies, you can add long term care as an optional rider on the policy. And number three is your accumulated cash value, which can give you flexibility with the premiums. This means if you ever can't pay your premiums for some reason, they can be paid out of that cash value. Other benefits that can be included with a permanent life insurance strategy can be advantages like absolutely no market risk, long-term care coverage, tax-free growth, tax-free income, and a tax-free legacy. Avoiding taxes is extremely important to consider because it can directly and significantly impact how much money you'll live on in retirement and the amount you'll leave to your heirs. Let's talk about what the cash value component of permanent insurance is and why it can be so important. A portion of your monthly premium is set aside in an account that grows over the life of your policy. The money in that account is your cash accumulation and can be used to fund future purchases. You see a few possibilities on the screen there. In addition to no market risk and tax-free growth, income, and legacy, as we had just mentioned, life insurance cash value can also be creditor proof, meaning creditors can't come after it. When you look at them all together, the advantages of the cash value benefit are very powerful. We saw that long-term care can be added to a permanent life insurance policy as a rider. So let's talk about the importance of long-term care insurance for just a moment. You may not know this, but 70% of people age 65 and over will need some type of long-term care services and support at some point in their lifetime. In other words, statistically, you will likely need it. But here's the thing, only 8% of people over age 55 have purchased long-term care insurance coverage. That sounds like a possible problem and an expensive one waiting to happen. Long-term care insurance coverage helps cover out-of-pocket expenses that can really add up. It can be used to pay for qualified services like nursing home care, home health care, assisted living care, or adult daycare. And you never know it or when you might need it. And if you do, the average long-term care need is, if more than 1 year, it lasts 3.9 years. As you can see here, the average total cost can be a crippling expense if not covered by a policy. The cost without long-term care coverage could drain one or more of your savings assets you are counting on in the future. So there are a couple long-term care options you should look at. The first is a traditional standalone policy. Even if you don't have life insurance, you can go directly to an insurance company to purchase a standalone long-term care policy. Or you can opt to add a rider to your permanent life insurance policy. If it's available to for your permanent life insurance policy, you can add long-term care protection to the policy in the form of a rider for an extra cost. So everybody should look into this option. If you go with option one and buy a traditional standalone policy, there are a few things you want to know, like the fact that premiums start low, but insurance companies can raise rates on them. Also, you usually pay for care up front out of your own pocket. then get reimbursed, which can be seen as an inconvenience during a difficult time. So another thing to keep in mind with the standalone option is that you could spend thousands on premiums and get nothing back in return. Although there's a 70% chance you'll need long-term care, there's also a 30% chance you won't. Or you can go with option 2 and choose to just add a long-term care rider to a permanent life insurance policy. A key advantage of this option is that life insurance companies typically don't raise rates for life insurance policyholders. Some insurance companies, after a waiting period, pay you money to cover long-term care expenses, which you can spend however you see fit. No need to submit receipts once the eligibility requirements have been met. Coupling your life and long-term care protection can equal a big savings. If you're one of the lucky 30% who ends up not needing long-term care, your premiums aren't wasted. And instead, your family receives a larger tax-free death benefit. Long-term care riders aren't the only riders available. You can also consider other living benefits like critical and chronic illness riders that can help save the day if you face any of the health challenges like you see on the screen. You should discuss adding these riders to your permanent life insurance policy with a financial professional. Some are inexpensive or even cost nothing to add to policies. And so our mission is to teach 20 million families how money works within the next decade. We're going to stamp out financial literacy in every community. That's a huge undertaking and one that will require an army of thousands of How Money Works educators. So we are looking for people to help us teach these classes, and that's where you or somebody you know can come in. So we're at the end of today's element class, and think about which concept resonated with you the most. That's why we started on this mission of eradicating financial illiteracy. This is how you start to take control of your finances. We call it the money discovery. Part of attending this course is we can help you if you don't have a financial professional yet. And this works like driving directions on your mobile phone. 2 points of reference are all you need. Where are you and where do you want to go? The same is true to chart the course for your financial roadmap. The How Money Works Money Discovery in the book can help you take care of that. And so our How Money Works experts are available to sit down with you now that you've attended one of the elements classes. And the question is, how do these concepts work for your financials and your personal numbers? And how much faster will you be able to complete those 7 money milestones when you have an expert that's guiding you? Your discussion will be private, short, and focused exclusively on your financial goals. And so if you're interested, our experts can crunch your numbers, make recommendations, and give you access to the best products and services available. So feel free to text me or give me a call right after you watch this class, and let's start putting your money to work today. And so if you like what you learned today and you'd like to learn more, you can follow the How Money Works on Instagram or at How Money Works Official for practical tips and helpful resources. You can also check out my website that I'll send to you, and you can go on there and check out all of the resources, videos, and blogs, and all that good information. But anyway, thank you so much for attending and watching this, and I look forward to talking to you soon. And we'll see you next time. Thank you.